Hello and welcome to joining us live on the Investor Lab. Gabby and I are having an ongoing debate about whether the music fades out quickly enough. So if you can let us know in the chat, that would be awesome. I'm excited to welcome Callum to joining us today. Callum, how are you?
I'm great, guys. I'm disappointed. I forgot to work on my dance moves again. I forgot about the intro. So next time I'll do better.
Should I let you know?
Well, Matthew Pitt says we were spot on today. This could be the first time that we were spot on, even though we didn't know we were spot on.
Validation. Validation.
Yes.
Thank you,
Thanks,
Matt.
Thanks, Matt. If you are here joining us live, we'd love to see you here. Let us know. Let us know in the chat if you're here joining us live, because that's why we do it. That's why we do it live, so that we can do it with you guys here. Obviously, a lot of people don't join us live, listen to the recordings, but I encourage you to come and check it out. Gabby, how are you today? I asked Callum how he was, but I didn't ask how you were.
Oh, well, now I know who's more important. That's good.
Well, he's the special guest. I'm not sure if you saw. I'm not sure if anyone else saw the thumbnail art, but he is. Somewhat revered.
He
so
is
a lot of
our savior. Thank you. Thank you for joining us. I'm good. In case anyone can't tell by the funky lighting going on over here, it is quite early for us. Now, it's not early for Goose Time, but it's early for the podcast. So appreciate you if you are here live. I see new names here. Nifty, hey, welcome.
Hey, Nifty. Good to see you, Nifty.
I'm good. I'm just
hey, Jared.
tired. I've gotten
20%
Gabby, through my coffee.
Can I just say that you shouldn't be tired, because if anyone would like to know why we're doing the podcast so early that it's still dark and that's why all the lighting is weird, it's because we're going on a special trip for Gabby's birthday. Yay!
Yay.
So thanks for joining. Good.
Normal response to that. Good.
That is a great response. I'm glad that my efforts to celebrate your birthday are being well received. Hey, Callum. All right, let's get stuck into it. So what we want to talk about today is how to create a property portfolio that pays for itself. Now, one of the things that frustrates me to the degree that I've started to, let's just say it frustrates me, is the lack of ability or lack of willingness for people to give important, creative advice to help property investors get ahead in the current environment. It seems like everyone is stuck behind these shrouds of, legislative obligations where people are too scared to actually try and help people, try and give people the information they need to get ahead. Now, I'm going to put a massive, massive caveat on this episode that none of this is financial advice. We are people.
Make a banner, like an animation.
This is not financial advice. Everything that is discussed in this podcast is for education. Sorry, no, not education. It's for information and entertainment purposes only. You should go and consult with a licensed financial practitioner based on your own personal financial circumstances before taking any action on anything that you may or may not hear in this episode. Now, with that being said,
all those in favor?
Motion passed. Aye. Yes, perfect.
Wonderful.
That being said, I want to talk about something that's really important. Yields are going down, and they're going to keep going down. So back when we first started Dashdot in 2019, we were routinely buying properties with 6, 7, 8% yields. I mean, shit, we've even bought properties with double-digit yields. It is pretty high. And not only that, interest rates were lower. And so cash flow was much easier to find. And so in the context of building a scalable, profitable property portfolio, that was actually a lot easier when you had an environment where properties could cover all of their own costs and expenses. There was a few tools at your disposal that would make that a little bit easier. Trusts being one of those tools. Mm-hmm. Now, the challenge is property prices are rising faster than wages. And even though rents have risen extremely fast and will continue to rise quickly, probably faster than wages even on a long-term basis. One of the issues is that property prices rise faster than that, which means that yields go down relative to property prices. And what that causes is an ongoing and systemic trend of cash flow pressure in property portfolios. And so this is something that is important for us to think about how to manage so that people don't get stuck in their property portfolios. Now, a simple way to think about this is, or we'll just kind of take a little sidestep for a second. The big promise of property investing is that you'll achieve financial freedom, that you'll buy a bunch of properties and then you become financially free. And whilst that can be true, the unfortunate reality is for 99% of property investors, that is not true. 99% of property investors do not achieve financial freedom through property. And the specific reason for that is they don't have the tools, information, team, knowledge, support to know how to actually build a property portfolio that's going to get them beyond just one or two properties. Statistically speaking, 71% of property investors only own one property. Another 19% get to two properties, which means that 90% of property investors never get past two properties. And I would like to use some numbers to kind of explain a very large reason of why this is the case. Let's say that the average household has a savings rate of about $2,000 a month. Now, the average household is actually a lot less than that. So the average household is actually less than $1,000 a month. But for a lot of property investors, you know, they're kind of like financially oriented and they're trying to save and they're trying to do that kind of stuff. $2,000 a month is a sort of generally aligned kind of between $1,500 and $2,000 a month. If you're saving $2,000 a month, how much is per year? That's $24,000 a year. If you buy a $500,000 property on an interest-only basis, 8% LPR loan with a 6.1% interest rate, you're going to be negative cash flow by an average of about $12,000 a year over the first 3 years. Okay, so you've got negative cash flow of $12,000 a year. That means you can buy two properties. And then what? And then what? And then you get stuck. And so we have this problem where people start hitting the ceiling. Now, there's three constraints in every single property portfolio: access to debt, access to capital, and cash flow. You have to be able to manage through these constraints if you want to build a successful property portfolio that allows you to get beyond two properties to 3 to 4 to 5 and beyond. Now, it is possible to achieve financial freedom with around 5 properties. Obviously, more can be better, but with 5 properties, you're well and truly on your way. You can do it. But the problem is most people aren't able to get there because they're with constraints. Now, and I know that I'm chewing up a bit of oxygen here, and I promise, Callum, you'll get a word in edgeways in a second, but if we kind of go back in time a little bit, managing the savings rate aspect of this, i.e. your personal savings rate, wasn't as big of an issue because the properties would produce enough income that they could cover all of their own expenses. So therefore, they didn't have a drag on your personal savings. So if a property can cover all of its own expenses, then your savings could just be going towards the next deposit. And so that could be helping you with your capital, the capital side of the equation. If you were structuring your properties in trusts, you may be able to manage the debt side of the equation. But the biggest issue that I see at the moment, and I'm personally speaking to, I've probably spoken to on average, 5 investors a week personally, every week for the entirety of this year. And the problem is the same. The problem is the same almost for everyone. And that is that their savings rate is becoming the biggest constraint, or the cash flow side of the equation is becoming the biggest constraint in the property portfolio. And so what I want to talk today, Callum, with you about is I really want to unpack and explore ways that we can navigate through this. And specifically, one line that I've got on how to do this is to use your property's equity to pay for its own negative cash flow. And the way that I think about that is that if we can help people to expand their borrowing capacity, then we would then be able to allow them to turn their illiquid equity into liquid equity, which could then sit in an offset account, which could then cover the negative cash flow expenses of the property, and therefore a property could pay for itself. So that's the setup. What do you think about that, Callum?
Yeah, it's a very interesting point, Goose, and mirroring your thoughts, same on my end from most property investors. There's definitely the willingness to continue expanding their property portfolio, but it's about navigating those cash flow constraints. So I think it's useful to start with the why in this circumstance, because a lot of you are probably sitting there thinking, even some people I see in the chat here, it's like, well, I have a proven track record of purchasing properties with Dashdot, making fantastic returns, managing all of my cash flow for the last few years, and you still get in this position where you feel like it's challenging to borrow money. And the reality of it is that the deck is stacked against you as a property investor. And we need to appreciate that most people tune into this podcast. You're different to the average borrower out there who's taking on a mortgage. So the way the system is regulated, it's regulated by something called the NCCP. So it stands for the National Consumer Credit Protection Act. So that last bit at the end there is protection. That's the bit that is interesting. So effectively, the deck is stacked against you in a way that the bank believes, or the regulators believe, they need to protect you from you. So that's why it's so difficult in these circumstances to navigate out a strategy that allows you to proceed through those cash flow hurdles. So going back to what you said before, Goose, about using equity in properties to fund further acquisitions in the cash flow, that's something that sort of strategy is really on the nose with most banks, especially the major banks. And that's why most people end up in circumstances where the constraint ends up being their borrowing power, because banks don't like the idea, in most banks that is, of you funding further acquisitions with cash surplus. So it's about how we navigate through that and the correct lenders that we choose that are happy with that sort of strategy. And then we can talk about, how you need to structure the debt in various different entities to achieve that goal. But it's really about navigating through the minefield that is the NCCP and appreciating that you as a serious property investor, you're going at this like a business, and the system is not built on face value to be functional like a business without the right structure and advice.
So yeah, you said something interesting there. The NCCP is NCCP, yeah, is designed to protect people from themselves. What are they really trying to protect? So that people don't bankrupt themselves or something?
Yeah, so it's interesting. So this has been, a shift in the last 10 years that borrower responsibility has really been removed, right? And if you think about, the three of us, for example, right? I know you guys, I practice ultimate accountability for everything in my life, good, bad, or the otherwise, right? But that's not the way the banks think. And they've been regulated to this position where they are not allowed to do that. They effectively have to take on that responsibility of making sure you don't borrow too much money. But if we think about the types of consumers that's well suited for and it's there for, it's, John and Jenny Smith that are trying to keep up with the Joneses and try and buy a house that's far too expensive for themselves, or their level of consumer debt, credit cards and car loans is an unmanageable level. So we can cross-section clients like that. It's very practical for them to protect them from themselves. But if you're outside of that and you've got a very clear and granular plan for purchasing multiple properties, you're working with a company like Dashdot, you've got a heap of surplus cash to manage any cash flow responsibilities along the way, that's not something that without the right creative strategy is able to be considered.
Yeah, because it's super interesting, right? Because it feels like, and I'm sure you would agree, but I'll take your opinion on it too, but it feels like the banks aren't willing to take into consideration the holistic view of how much money or wealth you've created. Because let's just say, so for those of you who don't know, the average capital growth over a 3-year period for Dashdot clients is 63%. That's the average over 2,100 properties. Of course, like averages are averages. Some people get more, some people get less, but that's the average. So what that means is if you buy a $500,000 property, on average, using averages, you could make $315,000 a year, $315,000 over a 3-year period in capital growth. Now, let's just say you've saved up let's say you've saved up $240,000. So you have enough cash to be able to buy 2 $500,000 properties. Because to buy a $500,000 property using an 88% LVR, you're going to need about 120 grand in cash once you factor in all of the expenses over and above the deposit, right? So let's say you've saved up $240,000 somehow. Cool. And let's say you've got a $24,000 a year savings rate. Cool. And let's say that you've got plenty of borrowing capacity. Let's say you've got $1 million of borrowing capacity or something like that, right? That would mean that you have the capability and the capacity to go and buy 2 $500,000 properties. And if they're yielding at 4.5%, as I mentioned, there'll be negative cash flow on average over a 3-year period of about 12 grand a year, roughly, round figures, depending on which state you're buying in. Now, over that 3-year period, you could have, if you bought the 2 properties at the same time and you're just using Dashdot's averages over a 3-year period, made $630,000 in wealth. Now, on paper, your savings rate is all used up because your savings rate is 24 grand a year. You got 2 properties that are negative cash flow by 12 grand a year. Okay, great. So there's your savings rate. That's all gone. You've taken you had your initial $240,000 that you'd saved up. That's gone into the properties for the purchasing costs. Okay, rock and roll. And your debt, you use that to buy the first 2 properties. But you're $630,000 wealthier. Now, the issue that I have with this situation is why can't you use that $630,000 to cover the expense? Why is that not being treated as a relevant portion of income? Because if you had a strategy that could extend your borrowing capacity, let's say instead of having $1 million borrowing capacity, you had $2 million borrowing capacity. Why can't you take some of that $630,000 that you've created, liquidate that, turn that into liquid capital, then that just becomes spent. Because if you were to sell the properties, what would happen? You would have that cash. You could take that cash and you could go and get a Chinese dinner, right? Like, it doesn't matter. You can use it like money. And so why is it? Say again?
Succulent one.
Yeah, exactly. A succulent Chinese dinner, right? So this is democracy manifest. So, so to that degree, I mean, if you had the borrowing capacity, if you had the capability to have a creative financing strategy, why can't you take, let's say, if your properties are 12 grand a year, negative cash flow, 24 grand a year, you could take $30,000 of that $630,000, turn that into liquid capital, pop that into an offset account that covers the expenses. Rock and roll, Yahoo! You're off to the races. Why is that an issue?
A really good question, Goose. So let's imagine we took all of that and packaged it up even in a statement of advice. Let's say you had a financial planner that put that into a documented statement of advice. It's like, this is the strategy that we are specifically using. Dashdot are buying the properties, financial planner, whatever. So regardless of whether, the bank might see that as an interesting strategy, or they might even believe you. Maybe the bank credit assessor is like, oh, geez, that makes sense. I'd love to be able to approve that loan. The banks are not able to approve loans on transactions like that without a whole lot of creativity. It's like the club's been taken out of the bag. They can't do it. It's from a legislation perspective, it's not possible. So you really have to combine that type of strategy with the creative loopholes that actually do exist to keep pushing your borrowing power. And the reality of it is that might be your strategy in the background, but that's not really the strategy that the bank is considering when they're approving your loans. All of that liquid cash that you have, as far as they're concerned, whilst it's a bit of a stocking stuffer on the application form. This client, Goose, he's got $600,000 of cash. That's great, but that's not something that they're actively considering in your borrowing power assessment. It may as well not exist.
Yeah. Okay. So talk us through, what are the creative loopholes? How do you navigate this?
Yeah. So the primary lever that you have, and most experienced property investors, especially now, are well familiar with this strategy. In the last few years, it's certainly increased. The number one strategy is really just limiting personal name debt, whether that's properties owned in personal name, whether that's the amount of debt you have on your home loan, other unsecured debt, credit cards, car loans, etc. Because the biggest challenge that you have is all these creative loopholes that exist with trust, I should say. If you're in a position where you've got too much personal name debt before you try to get into that position, it's just a useless and futile strategy. So if we think about the long-term strategy, and if your average property investor out there, how they might get to five properties, unless they have quite a substantial personal income, it is simply not possible unless you limit personal name debt and look to use structures like trusts to silo out your debt throughout the process.
Okay, so let's walk through that step by step, right? So let's say that you are an individual, you don't have any credit cards, you don't have any personal loans, you don't have any car loans, you don't have any of that kind of stuff, right? Yeah. And you've got, let's call it like $1 or $1.5 million of borrowing capacity, whatever the number may be. How should a property investor who actually wants to build a scalable property portfolio, who doesn't just want to go buy one property and see how it goes, but somebody who actually genuinely wants to use property as a vehicle to achieve financial freedom, and they want to use trust structures, and they want to know how to do this, because my point of view is that the key lever here is extending your borrowing capacity. That seems to be the number one thing that you need to do in the current environment, is maximize your borrowing capacity. So do you want to walk us through step by step how that would work, and then how that would then translate to you being able to use equity to be able to cover the operating costs of the portfolio?
Yeah. So the first thing that we need to consider here is, so you mentioned the borrowing power for this individual being at $1 million, right? So our number one job as a strategic mortgage broker is to retain that $1 million of borrowing power and make it repeatable. That is the key to the strategy. So if we think about this theoretical client, assuming that nothing else changes, their income doesn't change, living expenses all stay the same, etc., that $1 million is essentially fixed. And it's thinking about, well, how do we duplicate that $1 million several times over? So let's imagine now, again, financial advice disclaimer, assuming this person had gone and spoken to their accountant or, solicitor, whoever it needed to be, to work out, okay, yep, I want to buy a property in a trust. So we need to set a limit on how much debt each particular trust should have for them to be able to keep proceeding. So effectively, if that's fixed at $1 million, it means so long as, let's say the client goes out and they buy 2 properties in trust number 1, and we keep that debt level below $1 million. Let's say there's $800,000 worth of debt in that particular trust. So the way the strategy starts to multiply after that is, provided that we can get that first trust to a position where an accountant is able to confirm that it's cash flow positive, which we'll come back to that, we can then repeat that process again in the second trust. And we're seeing the duplicating effect of them having the same fixed borrowing power for this next entity. And that's how the process continues there. And then if we go back a step to, how do we use equity and how do we use, cash, surplus cash that the client might have to help navigate through that situation, that's where we effectively end up with the strategy as you were discussing it initially, where it's like, so, theoretical client has surplus cash available that they're able to ensure that each particular trust maintains a state of cash flow positiveness. That's how we can continue through to the next transaction, by spreading that around through time.
Okay, let's dig in that a little bit more, because how are those? Let's say that everyone's buying properties that are going to be 12 grand a year negative cash flow. Yep. Right? Let's just use that as a baseline. That every property they're going to buy is going to be, we can simplify it, say 10 grand a year negative cash flow. How, and if people have only got, let's say 20 grand a year of a savings rate, and every property they buy is $10,000 negative cash flow, how does that work? How does that strategy work?
Yeah. So let's imagine we go back to the example where the client has, they've purchased 2 properties in the first trust. And let's say, they've bought through Dashdot, they've had an amazing amount of growth over a 2-year period. And let's say there's now, I don't know, there could be, let's say $100,000 of equity available between those 2 properties, just for argument's sake, right? Mm-hmm. So let's imagine that client then decides to go ahead and increase the loans against those 2 properties by $100,000. They've now got $100,000 of liquid cash. Yeah.
Okay. And hold up. Okay. So let's walk through this step by step, because this is really important to break down. So Johnny Magoo, the theoretical client, right, got $1 million borrowing capacity, goes and buys property and got $1 million borrowing capacity and a $20,000 a year savings rate, right? They can put towards property. They go and buy properties in a trust. They use up $800,000 of their borrowing capacity. Okay. And those properties are both of those properties are $10,000 negative cash flow a year. Okay. So all of Johnny's savings rate is used up by servicing the negative cash flow in those trusts. And then those properties go up by, let's say they go up by whatever, 150 grand. So they've got $100,000 of usable equity in there. Mm-hmm. Then what happens? Because Johnny's used up Johnny's used up 800 grand of his $1 million of debt.
Yeah. So if we go back to the figures for these particular properties, let's imagine by this point in time, this trust might be, I don't know, let's say it's $10,000 per year negative cash flow. It's likely to be more than that, but just to give you a round number, yep. Johnny has effectively captured there 10 years worth of debt servicing capacity in the cash that he has taken from the equity in that property. There's $100,000 worth of cash that could continue to maintain that trust for the next 10 years. So that's effectively where the equity that you have in that property can continue to maintain the cash flow requirements of that entity.
Okay, so the negative cash flow of the property is 10 grand. You take $100,000 out of equity, you pop that into an offset account associated with that property. That services 10 years worth of negative cash flow.
Yeah.
So then that puts that property in a cash flow neutral position.
Yeah.
And that means that property in that trust, that debt can now be siloed.
Correct. Under the right circumstances, you sit down with your accountant says, yep, okay, let's look at the figures together. Makes sense for me to write a letter confirming this trust here is able to meet its own commitments. And then for Johnny Magoo, it's effectively like hitting the reset button for his borrowing capacity in another trust after that.
All right, let's walk through this again. I'm going to just keep walking through the same shit over and over and over again, because it's really helpful. It's really interesting. And for a lot of people, it's quite hard to get their head around. Okay. So let's say I go and buy a property in a trust, and I've got all the appropriate advice to decide that that's the right thing for me to do. Good. Let's say I go and buy a property in a trust, and that property is negative cash flow by $10,000 a year. Now, if I do nothing, then a portion of that debt, let's say I've used $500,000 of debt to buy that property, and I've got $1 million borrowing capacity. a portion of that $500,000 of debt is still already going to be siloed in that trust, right? Because if it's negative 10, let's say my income is 150 grand a year, and that trust is negative cash flow by $10,000 a year, then the banks, subject to the lender that you use and all of that kind of stuff, would effectively dock my income by $10,000, so that assess my borrowing capacity based on $140,000 income, not $150,000. Right so far?
Yeah, loosely.
Okay, most okay, close enough. But that would mean that even in that scenario, even before I've refinanced equity out of the property that I bought in a trust, I would still have, in effect, extended my borrowing capacity. Correct?
With the right lender, yes, which I think is something that gets overlooked by most people with the whole the trust conversation, because the opinion tends to be, well, if I'm buying this property in a trust that initially it's going to be cash flow negative, most people theorize, oh, that's going to mean that, it's going to be bad for my borrowing capacity. But actually, with most lenders, it's actually not. That property being cash flow negative in a trust versus owning the same property in your personal name, even though you get the negative gearing benefits in your personal name, it is in theory a better cash flow equation. From a bank's perspective, if you were to be purchasing another property in a different trust with that first property owned in the first trust that was $10,000 per year cash flow negative, your borrowing power is still better in that circumstance with most lenders.
Yes, it depends on what you're optimizing for. Are you optimizing for day-to-day cash flow, or are you optimizing for maximizing your borrowing capacity? Right?
Exactly. And I think the optimizing for day-to-day cash flow, that for most property investors, that's where the scalability really disappears. If you sort of compare it, that sort of a model, it's like, okay, maybe you go and speak to an agency, you're like, hey, buy this new property here, you'll claim all your depreciation and you'll get a really handy negative gearing. You get some tax back at the end of financial year. And if that's the primary methodology which you're using to decide to invest, ultimately that's going to severely limit your scalability, because the number one metric that will allow you to accumulate wealth through property is ultimately buying more properties, which requires you to be able to get your hands on the debts. That's the bit that makes it actually work, not so much the cash flow. The cash flow is something that you just need to be able to manage through the time period.
100%. So let me go over this again. I'm going to keep rolling over. Okay, so in this scenario, I've got $150,000 income. I've got $1 million of borrowing capacity. I go and buy a property in a trust. I use half my borrowing capacity. I use $500,000 worth of debt. It's $10,000 negative cash flow. Okay, so then when I want to buy another property in another trust potentially, the bank will assess me as having less income, like $10,000 less income, because I've got to contribute $10,000 to trust number one. Okay, broadly correct, right?
Yeah.
Now, okay, so that means that instead of having 150 times 6. All right, cool. 1 sec.
You have about 900,000 borrowing power.
All right, so if I've got 100, okay, let's redo the scenario. So let's say I've got $150,000 income. I'd have about $900,000 of borrowing with no debts, no dependents. I'd have roughly about $900,000 of borrowing capacity. I go buy a property in trust number one, and I use half my borrowing capacity. I use $450,000 of debt in trust number one, and that is negative $10K a year cash flow, because it's a negatively cash flow property after all the operating expenses. Okay, so then I want to go buy property number two, and I'm going to use this. In the point of this discussion, I'm going to use a different trust. Okay, I'm going to set up trust number two, and I want to go buy another property. The bank is going to say, okay, well, you earn 150 grand a year, but you own this company, which is negative cash flow by 10 grand a year. So you need to put 10 grand a year over there. So rather than assessing your income based on $150,000 a year borrowing capacity, we're going to assess it on 150 minus 10, which is $140,000 a year times 6. That means I'd have $840,000 of borrowing capacity. Correct?
Yeah, it's only a marginal decrease in bank loan effectively.
Yeah. So at that point in time, I have a current borrowing capacity of $840,000, plus also I have the original $450,000 of debt, which I put into trust number one. So then I have 840 plus 450. So I've gone just in that act without even working out what to do with the cash flow. I've expanded my borrowing capacity from, this is all theoretical, by the way, for everyone listening, again, not financial advice. It's theoretically expanded my borrowing capacity from 900,000 to 1,290,000, right?
Correct.
Okay, cool. Let me just do this again. Let me just keep playing this out, Callum, and then you can tell me if I'm doing anything stupid.
Well, just
Right?
just one thing I might add there too. It's that with that overall strategy as well. It's like maybe you're putting yourself in a position where the levels of debt that you're getting your hands on, you start to end up with a fair bit of debt to your name. But if your strategy, perhaps it involves selling one of these properties that have performed fantastically well in 3 to 4 years' time, there's no allowance in borrowing power assessment for that. So without this type of creative strategy, that sort of outcome doesn't even exist. Even if on face value the level of debt that you may have at one point in time, is higher than you would like to hold for the extended period, it doesn't allow that type of strategy.
Yeah, exactly. All right, I'm gonna walk through this again. We're gonna walk it through again from the start. We're gonna go to a third property, okay, or we're gonna go to a second purchase. Okay, so at the start, I have $150,000 of personal income. I have no dependents, no personal debts or anything. So 6 times that is $900,000. I have about a $900,000 borrowing capacity. I go and buy a property in trust number 1. I use $450,000 of my $900,000 of borrowing capacity to buy the property, and that property is $10,000 negative cash flow. Also, I have a savings rate of $20,000 a year. Right, fine. Now, I then go to buy property number 2. The bank says, oh, okay, you earn $150,000 from your income, from your job or whatever, but you also own this company, which costs you $10,000 a year. So we're going to assess you on $140,000 a year of personal income. 150 minus the 10 that you've got to pay to that company that you own, that is negative $10,000. So then I will have, I will then have 140 times 6. I will have $840,000 borrowing capacity plus the initial $450,000, which is in the first trust. So I've expanded my borrowing capacity to $1,290 borrowing capacity.
1,290,000.
So yeah, 1,290,000. Sorry. Yes, thanks. Okay, so then I go, okay, great. So now my borrowing capacity is actually more than it was. Perfect. So I'm going to go and buy another property. I'm going to go buy another property in trust number 2. Okay, and again, I'm going to use $450,000 of debt. And again, it's going to be negative cash flow by $10,000 a year. Okay, great. So I do that. And then I go to buy property number 3. And the bank says, okay, so you earn $150,000 a year, but you own one company that's negative cash flow by $10,000 a year. You own another company that's negative cash flow by $10,000 a year. So that means we're going to take $20,000 off your $150,000 of assessable income. We're going to use that to assess your borrowing capacity. So then that would be 130 times 6 would be $780,000 of available borrowing capacity at that time. But that would be in addition to the $450,000 of debt that I had in trust number 1, plus in addition to the $450,000 of debt that I got in trust number 2. So in total, my borrowing capacity at that point, inclusive of all of debt that I own and that I could get, would be $1,680,000. So I have expanded my borrowing capacity by not quite double.
50%. Yeah. Nearly 50%.
Well, be more than 50% because I started with 900,000. So I mean, it'd be more like 75% or something like that.
That's wild.
Yeah.
It's wild. Okay. Now, obviously, that starts to tail out, and the issue then becomes cash flow management. So then I say, okay, well, all right. So I've got the total debt capacity of $1,680,000, of which I've already used 900 because it's in the 2 properties that I bought. But those 2 properties are negative cash flow by 10 grand each, and I have only got a savings rate of $20,000 a year. So what do I do now? Well, if I take some of that borrowing capacity, that I've got $780,000 of borrowing capacity that I haven't used yet, in addition to the 450 I've got in each of those trusts. And if I go back to trust number 1, and let's say over that period of time, that property has grown in value by, let's call it $150,000. And I say, well, I'm going to take 100 grand of my $780,000 borrowing capacity. I'm going to use that in trust number 1 to leverage $100,000 of equity out of that property, which has gone up in value. And then I'm going to put that $100,000 of equity, which I've just taken out of that property, I'm going to put that into an offset account so it can service all of its own cash expenses for the next 10 years.
Yeah.
I'm on track there?
Correct. Absolutely.
Now let me just keep playing this out. That would then mean that trust number 1, if I got an accountant's letter that asserted this fact, would be self-sufficient under its own means based on its own. It has enough cash to support itself.
Yeah.
So that would mean that I had $780,000 of debt outside of the trusts at that point. I used 100 of that in trust number one. So that went down to 680. But if I was able to silo the debt in trust number one and to be able to prove that that company was fully funding itself and didn't require any of my additional capital, not only would I get the $450,000 of borrowing capacity back, I would also get the $100,000 of borrowing capacity back. So I would get $550,000 borrowing capacity back. So then I'd have 780 plus 450. But in fact, I wouldn't be 780. I would be 140 because I've taken the $10,000 of negative cash flow off the table. So it'd be 140 times 6, 840 plus the 450. I would then be in a position where I have $1,290, $1,290,000 worth of available debt. And I own 2 properties in a trust, and I've now got more borrowing capacity than I started. Is that?
Absolutely. And the main point of that, I suppose, is if you can consider that outcome versus trying to do the same thing in personal name, even with just one property owned in personal name. Let's just say you decided, no, I'm going to buy the first one in personal name and then do that. That equation starts to get so much more difficult through time to continue to be able to make it repeatable. And it's absolutely not possible if it's in personal name. Even if you're buying properties with a 10% yield, you're using all the non-banks with the best borrowing power calculations. It's just simply not possible.
Yeah. That's an important point to remember. It's like you can't do it in your personal name. The system is built such that you can't do it in your personal name.
Exactly.
So if you play this out on a long enough scale, I don't want to overstate this, and I don't want this to be hypey, right? I'm just making an observation. But if you play this out on a long enough scale, and if you understand how to continue to play that juggling act between expanding your borrowing capacity, liquidating the capital inside the trust, using that to service its own expenses, and so on and so forth, it does start to feel like you can almost not run out of borrowing capacity.
Definitely. And I'm actually going to use a reference of one of the people that's in the chat here. I'm not going to divulge your personal details, so don't worry. But seeing the fruits of that play out through time, and this client have actually now reached the point in time where they've hit their initial goal of properties. They're above 5, and they've already exceeded what their initial plan was. And it's played out through time where there's 2 properties per trust in 2 different trusts. We've just bought the 5th property in the last trust, and it's been this dance for the last few years of doing equity releases against property, spreading that cash around, ensuring the accountant's able to provide an accountant's letter. And for this particular client here, they're kind of the poster child for this. They got rid of a property they own in personal name. So this strategy is able to continue through time. And it's probably only been, I think, 5 years for this particular client since the start. And they've already exceeded that goal. And every single one of those trusts is now able to maintain a state of positive cash flow. So yeah, the proof is definitely in the pudding.
I think it's a real game changer when people realize that they can take the equity out of the properties in the trust, make that liquid, and that becomes capital that can service the expenses in the trust. And that actually then therefore can mean that the trust can be self-sufficient under its own steam. That's wild, isn't it?
Yeah, definitely. And it's not something that if you go to your average broker around the corner, they won't be familiar with this strategy, because going back to what I said at the start, we need to appreciate most people here in the chat, you are different to the average borrower, and you're different to the average property investor even. So your local garden variety mortgage broker, they'll be able to help you with, we'll get you the cheapest interest rate for this particular loan. Let's go to ING because the rates are good. Buy it in your personal name. Don't worry about any of this trust stuff because they don't understand it themselves. So it's really about finding your mark with the right broker and the right team that's aligned with this long-term strategy. Otherwise, it will just never happen in the first place. Like I could probably 100%. Count on one hand the amount of brokers around Australia that I know are capable of delivering this particular strategy. That's outside of Dashdot Finance. There are other brokers out there, but they're few and far between. Yeah,
I 100% agree. And I think like even just thinking through this strategy, like I'm kind of in the same sort of position as you, Callum. It's like I don't even know of anyone like I started thinking about this sort of myself. Like obviously it's been built on, other stuff that has been learned, but I started thinking this myself because I was like, I was seeing all these people that are having cash flow issues. And I was like, okay, well, let's take the illiquid capital and turn it into liquid capital and then use that to fund the expenses and off we go. And then not only does that help on a cash flow basis, not only does that mean that a family, a mum and dad that have got $1,500 a month savings rate, not only does that actually mean that they can actually grow a significant portfolio and they're not just going to get stuck at one property, it also can expand their borrowing capacity. Like it's a total game changer. And I don't even know anyone who's even thinking this way, let alone actually acting this way. And it's a huge unlock. It is a massive unlock, particularly in an environment where cash flow in and of itself is becoming less and less pragmatically available.
Yeah. I think the other part of it too is you've got to think about your time horizon, right? So some people listening to this, you might be quite gung-ho and you might be very comfortable with debt and accumulating a massive amount of debt within a short period of time, in which case a strategy like this, it can work quickly. But if you're slightly less, if you're a bit more risk averse, this is still the same strategy that can play out through time. It could just be a slightly longer time horizon for you to develop a level of comfort with holding that level of debt. Because on face value, to some people, there's a level of fear associated with holding that amount of debt, and maybe time helps you appreciate the value of the strategy.
Yeah. Yeah.
I just want to quickly point out, I just want to point out something as well. Like this strategy, like Callum, you're incredibly strategic with this kind of stuff. Even the way that we're saying like, this is wild. And you're like, yeah, it's normal. Like you feel like this just makes sense because that's how you think about things. And I think maybe that's also your ability, and I think Dashdot's ability, it's like to adapt to the times. And so I think back to like, the start of Dashdot, it was a very different market nationally in Australia, and things that worked at that time. And so it's evolving as a property investor to adjust your strategy to what is working right now if you still want to continue to buy. It doesn't mean that if you bought in your personal name in 2021 that was like a mistake. It's like you're probably experiencing now borrowing capacity issues, but it still helped you to get from A to B and it was still valuable. And it's just going through this process of adapting to the times is kind of like to some people, this might sound like a really complicated strategy, but it's like, if you really want to achieve your goals, it's like you need to adjust the strategy to meet the times. I think that's important to remember.
Really totally. And I actually think that people are more like what people want to know is like how to do it. That's what people want to know, because everyone's got the idea like, okay, so I believe in property and I want to invest in property, but like people are also smart enough to go, okay, great. So this property,
what happens
is going to be
number 2?
Yeah. Okay. So I've got 20 grand a year in savings rate and the property is going to be negative cash flow by 10 grand a year. Okay. So I can buy 2 and then what? like people are not stupid. And so actually being able to say, hey, look, here is how this works. It is like giving people the master key that unlocks everything else. Because as you said earlier, Callum, like the secret to being successful in property investing is actually being able to buy multiple properties, right? Like you could buy, if you can only buy one property, you could buy the best property in the best hotspot, in the best timing. You could get everything absolutely perfect. But if you can only ever buy that one property, yeah, you'll build wealth. That'll be fine, but you won't become financially free. Won't happen. Won't happen. So like, yeah, you've got to buy the right property in the right place at the right time, but you have to buy multiple of them, right? You have to do that several times over. You can't just buy one, right? You can't even just buy 2. And again, I'll restate, you will build wealth. Like you will be financially better off if you do that. But there's a big difference between being financially better off and being financially free. And if you actually want to achieve the goals, you actually have to have a strategy to be able to buy multiple properties. And again, no one's talking about this stuff and giving people the key. And I have actually been talking to people about this, and I've just been going, because people are sort of approaching me and they're going, all right, but I don't understand. Like, surely I'm going to get stuck. And I'll be like, well, okay, not financial advice.
I'm just going to tell you.
Let me explain to you how this works. And 100% of the time where I've explained this kind of thing to people, it's like people just like penny drop. They're like, fucking thank you. You just gave us the answer. I can now see how this works. And that instant transition from confusion to confidence that alone is worth it, because you actually give people the confidence to know they can actually achieve their goals. Now, I want to just I want to just pick up a couple of this. There's a question here about using equity from property one in trust one and all of that kind of stuff. So let's talk about that too. So let's go through. I like to do imaginary scenarios because it kind of makes it a little bit more tangible, right? So let's say again, I've got.
Just before you start, Goose, the
Yep.
question above from End Collar, it's really the same question.
Yeah. Okay. Perfect. Yeah. How would you assess managing loan agreements between related entities? Okay. Cool. I'll walk through the scenario. You tell us how it works. How does that feel, Callum?
Yeah.
All right. Perfect. Okay. So let's say again, I've got $150,000 personal income. I've got no dependents. I've got no personal debts. I've got 900,000 borrowing capacity. Yahoo. I've got $20,000 savings rate. Great. Fantastic. Okay. So I'm going to go and buy a property in trust number one. I'm going to use $450,000 of my. Oh, by the way, so I've got $150,000 income. I've got $900,000 borrowing capacity. I got $20,000 savings rate, but I only have $120,000 of savings, right? Something like that. So then I go buy a property in trust number one. I use $450,000 of my debt, and I use $120,000 of my capital to buy roughly a $500,000 property on an 88% LVR. Roughly, there we go. Right, so I'm going to use all of my savings, right, that I've got. So I'm going to use all my cash. I don't have any more cash for a deposit. I've used half my debt, and I've used half my savings rate. So I've got $10,000 of savings rate. I'm still saving about $833 a month. Okay, because I've got $10,000 that go into to service the other negative cash flow. Now, property number one. $500,000 property, we'll call it, goes up in value by 20%. Okay. So it goes up by, what's that?
620 it would be.
620. Thank you, Callum.
Nice.
Right? Don't do public maths.
Why'd I pick that up?
Shit. It's like shit. I do things in multiples of one.
Well, you do it all on the fly, so
Yeah, I know. I try not
grows
to do
by
public maths.
100%.
Yeah, yeah, but it's either by 10 or 100. Okay, so you got 6. Okay, so now let's just theoretically say I could leverage that $120,000 of additional gain out of that property to go and buy another property. How would I take equity from trust number one, and how would I take equity from trust number one and move it into trust number two to use it as the deposit and costs for property number two? How would I do that, Callum? And then how does that work on a borrowing capacity basis?
Yeah, good question. Well, I think John D's cat might be walking on his keyboard or something, but nice to hear from you, mate. So to your question, in terms of how that works practically, from a lender's perspective, let's say you decide to do this equity release in trust number one, you decide to take that pile of cash and then put that down as your deposit in trust number two. That's not something that the bank really cares about. They're not privy to what's going on behind the scenes there. They're just seeing that as you having some amount of cash that you can use for the deposit. But really the part that you need to consider here is the accounting side of things, which there's too many variables to go into there, but it really highlights the criticality of having the right accountant to pair with this strategy. Because much the same as with mortgage brokers, most accountants are not super privy to all the machinations that you might be going through to allow you to do this. So there's a whole bunch of Div 7A loan considerations that you need to think about. But it really turns into a bit of a money circle in practice, but it's a bit difficult for us to go into that in the context of this chat here. You just need the right accountant to help you with that through time, because there's a lot of steps to it.
Simplistically, though, there's only like two ways that you could move the money from one entity to another. One, you could distribute it you could distribute it to the beneficiaries, but then that would be taxed. I'd imagine. So you could let's say that you take that $120,000 out of the trust entity personal. None of this is tax advice. We're not accountants, and this may or may not actually even be correct from a tax basis. So just take this lightly. But if you distributed it from the trust, you're probably going to pay tax on that because that would be deemed an income or something like that. Yeah. And then if you wanted to distribute it as a loan from one entity to another one, as a director of one company, you could do a Div 7A loan to borrow that money out. Then that would be a free money transfer that you could then Div 7A loan that into another entity. And you'd have to do that. That'd have to be structured with genuine loan agreements and all of it. There's like a whole process you need to follow. You can't just be like, oh yeah, it's just a Div 7A, just, off you go. It's actually got to be done properly. But theoretically, that's how you would move the capital from one entity to another entity to then use it in that way.
Yeah, and I think just to second to your point there, and Colin, answer your question, it's I perhaps made it sound more complicated than it is. It is really not, for the right accountant to make sure everything's structured correctly with loan agreements, and to make sure you avoid having to pay yourself too much money in personal name. But that's something that you can work out through time as you progress your portfolio with the right advice.
Yeah.
Would you say then with that, Cal, if they're going to their accountant and feeling that they need to explain this to their accountant, then it's probably not the right accountant?
Absolutely, yeah. So the standard approach that we have here is I'll give the client a bit of a brief on, from a borrowing power perspective, why we're looking to do what we're doing. They'll take that to their accountant, and oftentimes, like you said, the accountant either won't understand the strategy, or will oftentimes even tell the client not to do it because they don't understand the strategy. And we need to appreciate that most accountants are coming at this from a tax perspective, and that's what they're thinking with the first lens first. They're not really thinking with a long-term wealth creation strategy of, okay, this allows client to purchase more assets through time. So it's about finding your mark with the right advice there.
Yeah.
Yep.
Love it. Is there anything about, given the nature of what we wanted to cover in this conversation, is there anything you think we haven't covered that we should have covered?
Yeah. So the other thing, which I think is a massive lever for a lot of people in scaling their portfolio, is really doing an assessment of the properties that you currently own, especially if they're owned in personal name, and working out whether that is an asset that you should be hanging on to, or what the opportunity cost is of you keeping that property versus if you sell it perhaps, and then free up that borrowing power to move to this trust strategy. The outcome of that can be massive. And there's certainly a reluctance. Most people, they come to Dashdot even with this perception of, you just buy a property and you hold it for 20 years and that's how you make money. And it's really about that critical evaluation of, well, is that actually true? And is that actually the best outcome? Which, it's something the client's going to have to evaluate for themselves. We're not going to tell them you need to sell this property, but it's about presenting the data and working about how, from a borrowing power perspective, moving on from this particular personally owned property will allow you so much more borrowing power for transaction 2, 3, 4, 5, and 6 after that.
Yeah, it's such a good point. And people think about the properties they own as the primary assets. I actually think about it slightly differently. I think that your primary assets are the resources in your portfolio.
Absolutely.
So your capital, your debt, and your cash flow. And so if you have a property in your personal name, it could even be a decent property in a decent location that's going to perform just fine over time, but it actually could be locking up the most valuable resources in your portfolio, which could be debt and capital. And by selling that, you could then, in effect, over time, not just end up owning that one property. You can end up owning 2 of those properties or 3 of those properties, in effect, by structuring in the right way so that you can maximize it. And so taking a critical, that's a very, really important point, because we just had some clients come on board, really amazing people. I'm really excited to be working with them. And they want to grow their property portfolio. They're smart enough to recognize that if they don't structure things in the right way, they're going to get stuck. They can buy another 2 properties. They're fairly well off, but they also have 2 properties in their personal names, which ostensibly are probably fine. Like they're in like decent enough locations and stuff like that. They're ostensibly probably fine. Certainly, I don't think they're going to be like screamers in terms of performance over the next few years, but they're probably fine. And our senior portfolio strategist actually pinged me, because he's working on building their portfolio plan, and said, hey, so we can obviously go buy 2 more properties with these guys, but I think we're going to need to talk to them about selling the 2 properties they've got in their personal name, because those resources are going to get stuck and we need to reallocate those resources better. Do you think and the question was like, do you think the clients would be open to having that discussion? But it's really interesting to even think through that, to go, okay, well, you actually really need to take stock of your whole portfolio and really ask yourself, have you allocated capital in the right place, in the right ways? And if you haven't, be prepared to reassess that if that's going to help you to get to your goals faster.
Definitely.
Yeah. Just to validate it further as well, like we have clients that have been with us for years. They've got properties that they bought before Dashdot, and then they've got properties that they bought with Dashdot. And it's like they can sell 2 that they've got in their personal names, that frees up the BC and moves it into the trust. And now they can buy, I think they're going to buy like 4. And it frees them up to be able to do that. So it's like they've made enough growth that they have the extra capital that they can use for deposits, but it's also freeing up that borrowing capacity massively as well.
Yeah,
And
totally.
also,
and look,
sorry. And the other thing too with scenarios like that too, Gabby, it's like, let's imagine you come out of that transaction with a pile of capital, and you can immediately have enough capital to be putting down deposits on multiple properties, plus also have excess capital available to ensure that those properties you bought in those trusts are already cash flow positive to allow it to be repeatable from there. So it really just multiplies after you make that decision.
Yeah.
Just to go back to that example that we walked through earlier, where we started with 900 grand of borrowing capacity, we bought in property in trust number 1 using $450,000, then bought in borrowing capacity, then bought in trust number 2, etc. And we walked through that. We started that scenario that we walked through. We started with $900,000 of borrowing capacity, and then by the end of it, we were at a theoretical $1,180,000 of borrowing capacity. That expanded the borrowing capacity by 86% in 2 moves. Just in 2 moves, just in 2 property moves. Just in 2 moves, we expanded the borrowing capacity. It's crazy. Not only that, we found ways to mitigate or minimize or negate or neutralize negative cash flow constraints as a kind of a stressor. Because a lot of people have really got that consideration. Like, cost of living is a lot higher. It's getting harder to get ahead, all of that kind of stuff. And so a lot of people are really worried. Like, well, if we buy these properties in negative cash flow, like, what happens if the car breaks down, or what happens if something, like, are we going to be putting a lot of pressure on ourselves? But if you work out how to play this strategic finance game, you can take all of that stress away. Your portfolio can start to pay for itself. You can expand your borrowing capacity. You can move faster. Your capital will expand. Your portfolio will expand. You'll achieve financial freedom so much faster. Speaking of achieving financial freedom, I just want to just something popped into my head that I thought I'll share, which is sort of related but not related. It is related in a way. Gabby was doing some numbers this week and worked out that on average, the properties that we've bought for our clients, the Dashdot properties we've bought for our clients, double every 4.8 years on average. That's 1.8 times faster than the national average. So now imagine if you've got a finance strategy that allows you to expand your borrowing capacity, and you've got an acquisition strategy that allows you to grow your wealth on average 1.8 times faster than the national average. How much more quickly and safely are you going to get to your goals? That's crazy, right? Then you start to really unlock this really powerful flywheel effect that actually moves you further forward faster than anything else. I'm excited by this. I think this is good. What else do we need to cover, Callum?
There's a quick question here from Peter B. Pete B. Any LVR limits, interest rates considered for buying in trust? So that's one worthwhile consideration. Is the cost of doing business does increase slightly. You know, you've got banks at the moment like ANZ, Westpac, Bank of Melbourne. There's a bit of a loading on trust loans, but the LVRs are much the same. But it's one of those things that you've got to weigh up the cost versus the benefit. It's like, yes, your cost of funding might go up by 0.1, 0.2, but the net outcome just substantially outweighs sticking to personal name, and it's just something you have to soak up as part of your strategy.
Yeah.
And then the second one here from Pete B about moving your PPOR into a trust. So that is a strategy that some clients, when they're really looking to push boundaries, they do apply that type of strategy, and you can have a loan back arrangement for that particular property. There's a few moves to it, and obviously there's a lot of capital gains tax considerations, stamp duty, all the rest of it. But that's certainly something that clients that are really looking to push the boundaries do consider.
Yeah, that strategy, which definitely works. So you can have your principal place of residence in a trust, and then you rent it off the trust, and all that kind of, and you can start to sell it that way. That definitely works. But to your point, Callum, if you're sitting on your principal place of residence and it's doubled in value over the last however long, and then you go to just move it into another entity, you're going to pay CGT, you're going to pay stamp duty. There's going to be a lot of costs associated with that. You really need to consider that. But if you're thinking about buying a principal place of residence for the first time now, or you're thinking about moving or something like that, there's some reason that you're going to go and buy a principal place of residence, you could do that from the start. Rather than transferring your existing PPOR into a trust and having to deal with all of that headache, you could, if you are buying one, I happen to know someone who often is here in the live chat and maybe here right now, we don't know, who's thinking of buying a principal place of residence at the moment. And if they were to buy that out of the gate in a trust, they'd be able to deploy that strategy straight away rather than having to deal with transferring ownership later on, which could really work.
Yeah.
Awesome.
Cool.
Good stuff. I think we've covered a lot of this episode. I think it's been bloody awesome. Let us know in the chat if you think this has been valuable to you. Let us know if you've learned some stuff. This is like, I don't want to I'm not overstating this. The stuff that we have covered in the last hour is the thing that you need to know in order to know how to scale your property portfolio. There are several things you need. You need a clear, robust, definable plan and strategy to show you exactly get from where you are now to where you want to be. You need an integrated finance strategy that can help you to understand how to finance and fund your property portfolio so you don't get stuck on the financing. You need that supported by robust and sophisticated acquisition that's going to help you to find the right property in the right place at the right time to get the right results based on your portfolio needs. And then you need a team around you that is going to continually help you to optimize your portfolio as markets change and as your life changes, so that your portfolio stays dynamic and adapts to the needs of your portfolio over time. So I cannot stress enough how important this is, or how important all of those elements are. Let me just quickly take N-Collar Australia's question. The question on loan agreements. We sort of did cover that N-Collar Australia when we spoke about the Div 7A loans, about loaning between entities, but that's something you need to go speak to an accountant about. That's right, Callum?
Correct. Yeah. Or you could, maybe you missed it. Hit rewind. Maybe 15 minutes of us rambling. It was somewhere in there.
Hit rewind.
Rewind the VHS.
I was born in the 80s.
Yeah, we did talk about the loan agreements between entities in there for a little bit, but again, it's something you probably need to speak to an accountant about as well. So, all right, guys, this has been great.
Punchy.
If you found this episode valuable, share it with somebody else because they're going to find it valuable too. Make sure you hit the like button, hit the subscribe button. But definitely, like, this information that you've just gotten in the last hour is, this honestly, it's worth millions of dollars. The information you've gotten in the last hour, like it is exceptionally valuable. It's the secret to unlocking scalable property portfolio growth. And so, if you want to help somebody else with that, share this episode with them as well. Gabby, Callum, have you guys got anything to say before we wrap it up?
Yep. Shout out John M's cat. Thank you.
Special guest.
Special guest.
Thanks for joining us, Cal. It's been really, really valuable. Guys, if you are joining us live every week, we're back at the normal time, 12 p.m. Sydney time, every Friday. Have a fabulous week. We'll see you next week.
Thanks, guys.
Hey, guys.
See you next week. Bye for now.